Welcome to Stockholders' Equity, Part 4. By the end of this ACLET, you should be able to account for the declaration and distribution of a stock dividend and to explain in general terms what a stock split does. This ACLET is a continuation of Stockholders' Equity, Parts 1 through 3. You are still the accountant for ABC Inc. ABC is authorized to issue 120,000 shares of $1 par value common stock and 75,000 shares of $10 par value 4% non-cumulative preferred stock. ABC has issued 50,000 shares of common stock and 7,000 shares of preferred stock. While 7,000 shares of preferred stock are outstanding, only 45,000 shares of common stock are outstanding and 5,000 shares are held in treasury stock. The next transaction occurs on January 3, 2016. ABC's Board of Directors declares a 5% stock dividend on common stock. Distribution date is January 31st. Market value of the common stock on January 3rd is $24 per share. First of all, if ABC sends out cash for a cash dividend, what will it send out for a stock dividend? Stock certificates. New ones from your vault, not the used treasury stock certificates. So the first thing we need to do is figure out how many new certificates you, the accountant, will have to pull out of the vault to give to the underwriter. Leave yourself several lines in your journal for the accounts and we'll calculate the number of new shares. The first thing you need is the number of shares of common stock outstanding on January 3rd, 45,000 shares. Then multiply the number of shares outstanding by the dividend percent, 5%. 45,000 shares times 5% is 2,250 new shares. Next, we need to figure out the dollar amount to go with these shares. You can't make a journal entry with just number of shares. As long as the dividend percent is small, you can use the market value per share on the declaration date. 2,250 new shares times $24 per share market value is $54,000. Now we need to talk about accounts. Anytime the board declares a dividend, you can use a dividend account. This time you might call it stock dividends instead of just dividends. Or you can save yourself time in the long run and directly decrease retained earnings. Whether you opt for stock dividends or retained earnings, the account will be on the left side of the entry. The amount coming out of retained earnings, now or in a closing entry, will be $54,000. If we were going to hand the 2,250 certificates to the underwriter today on January 3rd, we would increase the common stock account. Let's do this now, although we will have to make a slight change shortly since the distribution date is actually January 31st. What was the rule about the stock accounts and par value? You can only put up to par value per share into the stock account. So 2,250 shares times $1 par value is $2,250. And where will the difference go? Into paid-in capital in excess of par on common stock. So accounting for a stock dividend is just like accounting for issuing stock, with one exception. ABC received no cash or other assets with the stock dividend. Instead, it decreased its retained earnings. If the board had made the dividend distribution date January 3rd, we would be finished. But since the distribution date is January 31st, you won't go into the vault until January 31st, and you won't pass the 2,250 stock certificates onto the underwriter until January 31st, so you can't use the common stock account until January 31st. The rest of our entry will stay as is, but on January 3rd, instead of using the common stock account, we'll use an account called Stock Dividend Distributable. This account is just like common stock. A contributed capital account increases on the right. It is increasing, so it's on the right side of the entry. Then on January 31st, When you hand over the 2,250 certificates to the underwriter, you clear out the stock dividend distributable account on the left and increase common stock on the right. When everything is said and done, the effect of a stock dividend is to reclassify a portion of retained earnings as paid in capital. We just rearranged the pieces in stockholders' equity. So why bother? What's the point of a stock dividend? Stock dividends accomplish a couple of things. First, most stockholders are pleased to receive free stock certificates. It's always good to have happy stockholders. Second, a stock dividend will generally cause the market value per share of the stock to drop a bit, in accordance with the rule of supply and demand. Believe it or not, decreasing the value of a share of stock can be a good thing if a stock's market value per share is high enough that few people can afford to buy it. So one way ABC can manage the market value of its stock and keep it affordable for investors is by declaring stock dividends. A second, even more effective way is by using a stock split. Good news here for you, ABC's accountant. A stock split does not require a journal entry since no account balances are affected. Let's assume that ABC decides to do a 2-for-1 stock split on its common stock. ABC collects all of the outstanding green certificates and in exchange gives out 2 new purple certificates. What do you notice about the new purple certificates? The par value has been split in 2. It is now half of what it was, 50 cents instead of $1. This means that the total par value of the new outstanding shares is the same as the total par value of the old outstanding shares. A shareholder who used to have 1 share of $1 par value stock now has 2 shares of 50-cent par value stock. Generally, the market value of each new share will be close to 1/2 of the market value of the old share. This makes each new share twice as affordable. This concludes the ACLET Stockholders' Equity Part 4.